Good afternoon, Quasar Markets Live. I got a good one for you, Bob Iaccino, man. How are you, Bob?
Good, man. How are you, Steve?
I love this. One of the things about Quasar Markets and what you guys are doing at Unfiltered Investors and all those fun things you're doing is that the professionalism. I love that side of it, right? I mean, I think a lot of times we see these traders with a million followers and really don't know what they're doing. And you guys
Yeah.
ourselves have been doing this for decades. And so it's good that we have places like us to do it. So I'm going to get out of your hair. Tell us a little bit about yourself and what you're doing and your company.
Well, first of all, thanks for having me on. I mean, one of the things I love about this format is we don't consider each other to be competitors. That's like my favorite thing, man. That's like we're all doing the same thing. We're all trying to get information out there. I've got my old school trading cards here, which you'll recognize, right? The buy and the sell side. We're just trying to get a message out there that people need to do this stuff responsibly. And so, look, what we do is try and give people a sort of short to medium term view of things. So, my background, I actually was in a family business with my father, my brother, my mother. We had an Italian food company, started off as an Italian bakery. And we ended up selling it, and I ended up going down to the trading floor. When I first heard about the Chicago Mercantile Exchange, I thought it was the merchandise mart. I thought my buddy's like, come to the exchange with me for a day. And I thought I was going to look at furniture and like haute couture clothing. I don't even know if I said that right. So I ended up getting a job down there, starting at the bottom, getting coffee and lunch for the guys I worked for, and just kind of took to it. And that's actually where I met my partner in the Unfiltered Investor, the Future's Edge, is Jimmy Iorio. I met him on the trading floor. And since then, I've done a lot of different things, worn a lot of different hats. I was a chief investment officer, part of a two-person investment committee for a fund of hedge funds. I worked at a prop trading firm. I did risk management for the other traders while trading for myself. Traded friends and family money, as well as having been obviously a floor broker for years on the Chicago Mercantile Exchange. Started doing television, CNBC, Fox Business, Yahoo Finance, CNN International, all those guys in 1999. By, no real statistically significant count, I just kind of go off the top of my head, I've probably done about 5,000 TV interviews. And I've sort of pulled back from that as I learned that, and I hope this doesn't offend anybody. Actually, I don't really care all that much. The CNBC to me has become the TMZ of financial media, and I will not even watch it anymore, let alone go on it. And I've pulled back from that as Jim and I's show has grown, because we're just much more able to say what we think about markets and then back it up by being on the very next week talking about the thing we said the last week. What used to drive me crazy is if I said something on one of these financial outlets, in the 3 to 7 minutes they give you, and it came true like 3 weeks later, and I couldn't be on to talk about why it came true, or it didn't work, and I couldn't be on to talk about why my view had changed prior to it not working, sometimes while it was not working. So it was just a really poor way of expressing what was going on. So that's the gist of it now. We have a newsletter called Finance Unfiltered. It's the Unfiltered Investor newsletter. And that's really everything we're doing. We have a website for that if anybody wants to go to it, unfilteredinvestor.com.
Yeah, I'm going to pull that up for everybody so they can see that, and they can click on that button. And we do this for all of our people. And I want everybody to go to this website right now. I'm going to put it in here in the comments section. I'm going to post it right now. Do me a favor, click on that button and go check out what they've got going on. And you can go see all of our guys that are here and partnered here with the Quasar Markets, because, I think one of the key things, Bobby, is that when we look at the markets in general, there's been this zero DTE, this mentality of gambling and this mentality of FOMO that sometimes we don't know how to reach them. Because a lot of people just lost their behinds in silver this week. And for us, it's like, wow, that was too easy, right? How do you connect to those people that are new traders? How do you get them going in the markets?
I'm not sure we do. I mean, I hope we do. One of the things we do is we like with our podcast, for example, which we're recording an episode about 2 hours from now. We do those live. We do them live on X, YouTube, and Rumble, and then they go out onto all the platforms as evergreen content. One of the things we do is we're ourselves. I mean, we talk about active trading that we're doing, but like, for example, my average hold time is about 25 days. You mentioned the zero DTEs. I think people are looking for a day to a week at the most, where again, my average hold time is about 26 days. But in our newsletter, since we lost it, 81% of our trades have gone to profit. Now, that's not a hard thing to do in a bull market. I need to stress that, right? You could pick random stocks and get that kind of win rate. But I think the two things that newer traders don't get, and this is what I'd like them to understand, is this is not gambling. You can actually gain an edge when you're actively investing, which is what I like to call it. You can gain an edge. If you hold things medium term, you don't try and compete with high frequency traders because you can't. They're operating in micro versions of nanoseconds, which none of us can compete with. So what I did when I left the trading floor is I pulled my view of markets back a little bit. On the trading floor, it was minute to minute. But as I got off the floor, I realized I can't compete with the guys who are working in micro and nanoseconds. So I started to pull back and reduce my position size. And that's what I do now. I do smaller position sizing than I used to, but I hold it for 10, 15, 20 days. We've had trades recently that have gone to profit the first and the second day. That's not by design. We just have targets that we use. And sometimes they go there quicker. Sometimes it takes a little bit of time. So what I try to get to the newer traders that we do reach is that gambling is just that. It's gambling. And the reason that NFL lines have a spread or a money line is because they're trying to make things a little bit more in their own, to their own advantage. By they, I'm talking about the bookmakers, right? The casinos. With trading, you don't have that, right? You can actually make the edge yours by trading the right way.
And so that edge that you talk about, how do you find that edge? What is it that you guys do differently than everybody else that gives you the edge? Yes, the decades and of course and the knowledge in the markets. But what else do you guys have that gives you guys that edge that you think you have?
Well, I'll tell you, the first thing to me is that we think of risk first, second, and third. So in other words, we may see a good example today, for example, or I should say, we put out our newsletters on Sunday morning, okay? And Monday morning, we had a potential long trade in GameStop on Monday, but we couldn't get the reward to risk right. You might be laughing, GameStop, right? But we'll do anything where the price action lines up, except for Roblox. I will not trade Roblox. We can go into that another time as to why I won't even recommend that to anybody. But we had a potential buy on the open for GameStop, and it rallied 8.25% that day. We didn't put it out. And the reason we didn't put it out is the reward to risk was not at least 1-to-1. Now, if you have an 81% win rate over a stretch of 10 to 15 years, you can take things where the reward to risk is not 1-to-1. But our win rate over the last 20 years is about 62%. So in order to keep the overall statistical math in our favor, we wait for at least a 1-to-1 reward to risk. What does that mean? That means for every dollar we risk, we expect to make $1 or more for every dollar that we risk. So we didn't put that out. We would have had a stock that went in the same day up 8.25%. And I know there's people right now going, well, you should have done it. I mean, it went up. Well, yeah, what about the times it doesn't go up? Then I risk $1 and I lose $1.95. Yep. And then over time, you have to have a much higher win percentage that we believe is statistically possible for most retail traders. So I think, Steve, that a lot of people think getting in and out of the markets is the better way. But I think when you do that, you're in a lot more than you think you are. And when we hold these longer term positions with staunch risk management and smaller position sizes, we believe we end up having less risk overall.
And one of the things that I talk about all the time is I love technical analysis. I love charts. I've been doing it since graph paper and pen, just like yourself. But it's not the end all be all, right? News is not the end all be all. Fundamentals isn't the end all be all. It's a little bit of everything, right?
Yep. So we'll do like, for example, we have a great technical analyst. His name is Mike Arnold. You guys should have him on one day, because it's funny when we ask Mike Arnold what he thinks of a stock, he says, I don't care. I don't really care. Do you like Tesla? Don't care. Do you like the cars? Do you like Elon Musk? Doesn't matter to me. It's all price action with him. Jim and I, on the other hand, will have theses. And I'll give you an example about, you might remember off the top of your head when it was, Steve. I don't. But you remember the Chipotle E. coli scare, right?
Oh, yes, of course.
I still lived in Chicago at the time. I no longer live there. But I drove by the Chipotle that's near the Exchange. right? It was still going down on the exchange on a daily basis. And I said, Mike, there's still long lines out here. We got to buy the stock. And he looked at the chart and he said, not yet. And it proceeded to go lower by about 45, 50% from when I said we should buy it. Because he said, no, the price action doesn't line up. As you mentioned, you like charts. So the charts don't line up with a buy right now. When we bought it, we ended up taking no heat at all because we waited for the right time to buy it. I would have, not only would I have taken a ton of heat if I would have bought it the day I said I wanted to, but I would have stopped out. I would have for sure.
Right.
So we combine these theses with the charts. And I'd say we're probably 75 to 80% technical. We have ideas, but if the charts don't line up to the ideas, we don't take it. I always say that charts are the steering wheel and the news is the gas pedal, right?
I like that a lot.
In the right direction so that when the news hits the gas, it's going your way as often as you can possibly calculate it.
All right, so good days, obviously 65% to 70% win rate here, but we all have bad trades. You know any bad trades you made,
Sure.
Bob? Tell us one of
I
those.
will tell you a bad trade that we made very recently. We took a trade in 3M that went against us immediately and stopped us out immediately. So, and it's funny because I always feel a responsibility to our clients to say, hey, we got in this. This was a few weeks ago. It was about December 11th or so. And we got into it and it immediately went lower. And then it continued lower after we got stopped out before it reversed. Now, we have trades that we're looking at that include 3M again. But the one thing that we don't do is we don't look at it like, okay, I lost money in 3M. I have to make my money back from 3M. We're completely agnostic about that. And I'm looking at it right now. It was actually January. When was it?
I can pull that. You can share your screen if you want to. If you've got.
Yeah, I'll show my screen because I'll be able to show you more about it. So we do a 3-target system. Okay. And the first target is where we, let's put it right here. The first target's where we adjust the stop. Okay. Second target is where we take some profits. And the third target is where we exit. Okay. So this is my 3M chart. All right. We got in this thing right here on about, I'm sorry, that's the wrong one, right here on about December 10th. It immediately ran up and hit our first target to where we adjusted our stop, right? The green lines generally are where the targets are. And then it made this move, right? Now we didn't get back in yet. Came back up, did some more activity, and then gapped lower. Why didn't we get back in here? Because I'm not looking at 3M and saying 3M owes me money. It's not the way it works, right? So kind of glad we didn't because we would have had different targets than the one I have lined up here. I always leave things the same on my chart until we get back in and I adjust the signals. So the blue line would be a buy. That's again what happened back here. We bought it on this little rally above the blue line. Then there's target one. We adjusted our stop. Then we got stopped out here, continued lowered, rally back up, and then just completely collapsed. At some point in here, we may have a new long for 3M, okay? But I don't care at this point. I don't look at this chart anymore until it becomes part of my modeling where I say, okay, it's time to look at 3M again. And we have, I actually have models that I run. I run them on Wednesday and I run them on Friday. They spit out a bunch of stocks and then I do actual chart by chart by chart analysis. I don't just trust the model to have kicked out the right ones.
Yeah, looking at 3M myself, what time frames do you like to look at, and what technical analysis do you add to your charts?
All right, so let me go to a clean chart. What's going to be a clean chart? We just got into Tesla. That's not going to be a clean chart. Let me pull up maybe. I'll tell you what. I'll pull up an ETF because I know we haven't done anything. Here's a consumer staples, right? And actually, part of the reason I believe consumer discretionary is a good place to look this year, because I think no tax on tips, no tax on overtime, as well as things like accelerated depreciation for CapEx is going to filter down to consumers. They're going to continue to spend on a discretionary basis. But what you're seeing on the chart here, this is just volume, right? And it's just a filter for me. I need an average 1 million more daily, or 1 million shares volume daily or more, or we're not going to look at it. We do have a section in our newsletter for more aggressive, more dangerous trades. Those are usually 500,000 shares a day or less, or something coming up to earnings. For example, we had a potential Tesla long, and it was approaching earnings for Tesla. It did not end up triggering. Tesla's obviously not a risky stock per se, based on volume, but because we were approaching earnings for Tesla, we put it in our risky section. And all we do in our risky section is we say, pay attention to your position size on this because it's a riskier stock. So that's just our volume filter. Down here is our percentage B histogram. Okay. Now we have proprietary settings on this, but I don't really care if people know what they are. So here you had and it's based off Bollinger Bands, as you know. So we put it in a histogram form. The histogram went below zero. The next day it went above zero and it closed above the previous day's high. That's often a buy signal for us. Now it wasn't on this one because the risk reward when it closed. We have to have a close above the previous day's high. Now this is on a daily chart. Okay. The stop goes below that same day's low. And that's all it is. And you could see it did work out. But again, we didn't take it because the reward to risk wasn't here. We'll do this on dailies and we'll do it on weeklies as well. Then I've got an 8-period exponential moving average and a 21-period exponential moving average, a 50-day, I should say 50-period exponential moving average, and a 200 simple. And that's all we have to analyze our charts. So let's switch this to a weekly, knowing everything is going to be the same. This is now an 8-week moving average exponential. This is now a 21-week exponential. Here's a 50-week exponential, and then again, a 200-day simple. So a weekly basis with the histogram again, right? Here is a week that dropped below zero. Here is a week that closed above zero and above the previous week's high, long signal. Okay. That's one of the things that we do to add value. We have this percentage B system that we look at. And if we get it, you can see another one here. Here's a week that fell below zero. Okay. The next week it was above zero and closed above the weekly high, right? There's a long signal again. There's another one here. Now they have to be side by side. So none of these, this one doesn't matter to me. This one only matters to me because the next week we get a close above. This one didn't work as well, right? Nothing's 100%. So we try and figure out, actually, you know what? This might not have been a signal. No, it was. Okay. Anyway, so that's some of what we do. Now, in terms of the moving averages, the moving averages for us form a rotation zone. So we don't trade moving average crosses. Okay. What we do is when they do cross, we watch for the 8 and the 21. This again is a daily chart.
Yeah.
Okay. We watch for an 8 and the 21 to angle sharply and widen, which you can see is happening here. Okay.
Now why 8 and 21 as opposed to the other ones?
That's my favorite question. It's because they tested out better, period. No other reason. When we tested them out, these are the two that work the best for what we use them for. We started with a 9 and a 20, just like most other people. And we also went to a 10 and a 20, like a lot of other people. The 8 and the 21 work better. So when we have a well-formed rotation zone that is angling up very steeply and the two moving averages are widening apart, if we got to move down into that rotation zone, as we did here, we will take a best fit trend line. It's not a very strict trend line, okay? It's just best fit. Just kind of draw it to kind of identify the trend. Doesn't have to be perfect, right? Could have done it here, could have done it here, don't really care. When we get a close above that, we'll go long at the close, all right? And then hopefully it continues to widen and push higher, which it did in this particular ETF. Now, the reason I called this one up is because we haven't done a trade in it recently. So I don't have any markings on here where it's like, oh, he just pulled up one that worked. This is a thing we look at. We look at it to the downside as well. So for example, if I go here, let me widen this chart out a little bit. All right. Here we had a cross down between the 8 and the 21. Okay. We had a rotation zone that was widening and moving down. Here we had to move up into the rotation zone. Here I would draw a best fit trend line right there. I like to actually to make it on the bodies of the candles. Close below it, and here's the down trade.
Look at that. All right, I like that.
So that's something we offer people. This is somewhat proprietary. It's obviously not that proprietary because I'm showing you guys this. I will tell you that the clue in the stock market is the long trades work better than the short trades because stocks have a natural upward bias, as everybody knows. right?
Yeah.
Month after month, you have long only mutual funds buying stocks, right? And that's all you can do with it.
And
Short
you have
trades
other
do
people
not
in your,
work as well, and they don't extend as far.
and you have people in your group that they'll ask you questions. Is that correct?
Yep, constantly.
I
We do
love
the
it.
live streams for that reason. And then again, on our website, we obviously have support tickets, but we're also available on the Slice app. And to be honest, I have to look that up
Okay.
to see what it is because it's a French-based website. It's more popular in the EU, but it is available in the US. It's slice-app.io.
Okay.
And we're up there as the unfiltered investor in the, I'm sorry, the unfiltered investor newsletter is up there as well. It's the same price, doesn't really matter. It's just which deliverable you like better. You know, you like getting the PDF on the website or you like getting it directly to your email. It doesn't matter to me.
And I will, I'll post that up there because I also use Slice every once in a while. That
Yeah.
is a European version of it. So I think a lot of people think it's just American versions of things, and it's not the case in a lot of times.
Yeah.
So there you go.
I actually like their platform. They don't have a marketing arm. So I think we have like 19 or 20 people on there. It doesn't matter to me.
I love it. I love it. All right. So any stocks you're looking at right now, Bobby, that you're interested in?
I will tell you in 1 second. I told you that I am looking at consumer discretionary stocks. So one of the stocks that we're pretty big on right now, but it's kind of outside our normal purview is Target.
Okay.
And what I mean by that is we told our, and you can see I have the lines up here, right?
Mm-hmm.
So this was our long trade. I want to be honest, it was done here, not here. Okay. We got in long on the Thursday, the 8th. And we put up to our newsletter subscribers, we said, this is going to be a longer term trade. And what we mean by that is the stop and the targets are a lot farther away than we usually have them. So we won't even necessarily be adjusting our stock until target gets our stop, till target gets to 124.95 up here. Okay. Where the screen line is. Now we will likely adjust it prior to that just for our newsletter subscribers because retail traders tend to get nervous.
That's
But
right.
us ourselves, we likely won't until it gets to that first target. And again, the only reason we said this was a longer term trade is because we think it'll take longer to play out. Okay, we truly do. I told you we had a potential Tesla trade that did not trigger. You'll see when I pull up my chart because again, I don't adjust things. This was the buy level. It was 454.32. If you look at the high here, 454.30. We had a stop at 454.32. We did not get in it. Obviously, we don't front run our own stops. All right. But the potential for that trade to trade again is here. Okay. This would not be our new entry level. Okay. Would put a new entry level. But we are looking at Tesla in terms of a sort of a medium term trade on that particular stock. And we don't have an actual level yet.
Mm-hmm.
And any other consumer discretionary stocks, I'll probably look at TJX, for example. I think people at a lower middle class to upper middle class range are going to spend in the next couple of quarters. I think they're going to spend quite a bit. I don't necessarily think that they're going to, go crazy and spend TJX, not TGX.
Oh, TJ. Oh, that's okay. Yeah.
Yeah. Actually, let me put it up. That's my personal thesis, is that that's what's going to happen. Again, we likely have to get above around 152, let's call it 153 before there's any interest. And then I'll need an actual bullish pattern to develop. I'll give you an example. Here we had the histogram at 0, and here we had the histogram at positive. It rallied, but we don't have a trade for two reasons. Number one, I need a negative histogram, not a 0 histogram preceding the long signal. And we're going against our rotation zone. We don't do that because the rotation zone has got power of its own. So I will throw something else out there that I'm sure people are thinking right now. If I get signals from both things, I don't take a larger trade. I think that goes against the conventional wisdom where a lot of people say, well, if you have two of your systems pointing in the same direction, you should take a bigger trade. I don't do that. I will put on two separate trades.
Okay.
Okay. And so you're saying, well, that's the same thing. It's not really because they'll have separate stops and they'll have separate targets. but I don't believe in exaggerating risk just because I theoretically have two things pointing in the same way. One thing may have a 70% probability of a gain, based on our research, but that still has a 30% possibility of a loss. Another thing may have a 65% versus a 35%. I don't know when those two losses are going to happen at the same time. So if I exaggerate my risk on the trade, I'm out of luck if it's one of those times where both particular systems end up in a losing vein. So it's going to break me. Losses are much harder to recover than people think they are.
Boy, they are, especially when it's percentages. Bobby,
Yeah.
it's rare that I get to learn something, and I love that, the 921. So I love it.
Hey.
And I guess I have one more question before I let you go. Can we have you back?
Shoot. Yeah, hell yeah. I mean, I'll always come back.
I love it. I love it. All right, Bobby Iaccino, you guys have all the info on them. Unfiltered Investor. I'm going to lay it right out there for you one more time. You can follow him. Please go out there and follow him. Sorry about that. I got Mike's up there too. There you go. Bob Iaccino, please click on that button right there. Hit him up a little bit and say hello. I know he'll answer the messages out there on X.
Absolutely.
And until next time, Bobby, we'll see you next week, my man.
Good to see you. Man, this was fun. Thanks for having me. I appreciate it.
Good.